Good evening, participants. Welcome to today's webinar on Market Insight for Fixed Income, where we discuss key updates related to economy, debt market, and our outlook. First of all, New Year greetings to all our viewers. Year 2024 was quite eventful for the markets. There were expectations of monetary easing from global central banks after the aggressive hiking cycle of 2022 and 2023. While Fed did start rate cut cycle along with some other global central bank, India is yet to witness the rate cut cycle. I am Anurag Mittal, product specialist at UTI, and I am joined by our head of fixed income, Mr. Anurag Mittal, to share his insights, perspectives, and outlook on fixed income markets. Post update from Anurag, we will open the webinar for Q&A. However, you can keep posting your questions anytime during the webinar on the link provided to you. Without further ado, I will now hand over to Anurag. Over to you, Anurag.
Good day, everyone, and very happy New Year to all our listeners. We hope that 2024 was a great year for everyone, and 2025 will even be a better year. So we'll start a fixed income outlook with the usual update on global trends, on how they affect fixed income outlook for India, what are the key variables that we are watching for Indian economy, and what kind of fund strategies make sense in this scenario. So if we look at how global growth is really panning out, it's divided quite well, with manufacturing being at stable but at a slightly lower levels, whereas services continue to be on an uptick. So if we look at services PMI, they have been in the expansion zone, which is above 53, about 53.8, and above 50 for consecutive 23 months. So what does that mean, and why is there this dichotomy? So basically, as we can see from 2022, as the post-pandemic normalization happened, and since for 2 years there was very low demand in services, consumers rotated from durable goods to services, and that has led to a very positive feedback loop between services and consumption, as services typically tend to be more localized, and they also tend to be more labor intensive than manufacturing. So as the demand for services picked up, it led to the demand for higher labor, and same way it translated into higher wages, which has resulted in better disposable income for consumers, and that's what's really leading to a stronger services growth. And on top of that, if we see in September, October, China has announced a very significant amount of monetary as well as fiscal stimulus, which should lead to stronger consumption in Asia also over the medium to long term. One of the key concerns that the market participants have been having is the change in administration in the US. We know that there's a new government which is scheduled to take place on 20th January in the US, which has come on an aggressive campaign of tariff hikes, restriction on immigration, and business deregulation. It's also led to comparison with the previous regime of the same administration, that how really it will affect global manufacturing, global growth, what does it mean for interest rates, and so on. We believe it's too early to really assess the impact of the change in administration. Moreover, we should take these themes in aggregation rather than singularity. So for example, while tariffs on one hand can be inflationary, on the other hand, business deregulation and extension of tax cuts is slightly deflationary. So both of them kind of offset each other. Secondly, what we also saw in the previous regime, as US introduced some tariffs, it led to some amount of demand destruction in the rest of the world, which which also led to global disinflation in some manufacturing goods. So we think that it's too early to say that probably the new administration will lead to higher inflation and hence higher for longer rates from global central banks. If we look at the right-hand side of this chart, in fact, both manufacturing and services, when the new administration took over in 2017, they took off for about 1.5 year before falling down due to Chinese slowdown, due to its localized real estate crisis. But broadly, economic activity, despite all the uncertainty on tariffs or immigration, etc., quite held up. And even this year, if you look at, although there are talks that there will be restriction on immigration, if you look at the current labor market also, there has been humongous amount of supply due to opening up of immigration in the last 2 years, and that the current US labor market is already digesting that. So we don't know for sure whether the proposed restriction on immigration may really lead to higher labor inflation. It's too early to call out, and we believe that it's better to fully wait for the impact and the announcements to play out before taking a deterministic call. If we look at commodity prices, and that's true for largely for the whole year of 2024, they have remained largely steady as individual supply side disruptions or demand were also offset by overall moderation in global growth, especially China. If you look at the Bloomberg Commodity Index, which is on the left-hand side, as we can see, largely it has been in a very tight range throughout 2024, where we saw a fall in prices of oil, wheat, and some industrial metals like iron ore. They were offset by a rise in precious metal like gold, silver. There were some weather-related disruptions in Latin America, which led to higher prices of coffee and cocoa. And of course, because of focus on electric vehicles, there was pickup in copper prices, which broadly led that the overall commodity index was quite stable. If we look at food price index also, which is on the right-hand side of this presentation, while YOY, lately the index has been rising because of a very unfavorable base last year. So if you see last year at the same amount of time, food prices were lower by between 10 to 15%. So yes, there's a base effect which has led to food prices rising YOY. But if you look at on an average for 2024, food prices were lower by 2.1% compared to 2023 due to seasonal disruptions broadly in vegetable oils, dairy, and meats. They were offset by higher production of cereal and sugar, which led to lower prices in these categories. So overall, again, food prices were also quite well behaved. Commodity prices were also well behaved, which portends well for medium-term outlook on global as well as local inflation. It's also a reflection that global demand continues to be moderate. If you look at the trajectory of global inflation, as we can see, the lines are looking to converge, whether it's US, UK, Eurozone, Canada, all across the advanced economies. They're getting close to their long-term target of 2%. And one of the reasons, of course, has been, we talked about in the previous slide, has been the energy disinflation, that oil prices have continued to remain low despite all the tensions in Middle East, which is basically a reflection of moderate global demand. Secondly, as we saw in the first slide, goods demand has also slowed down post-pandemic normalization, and that's why as the normalization happened in both energy prices and goods, inflation continues to stabilize. For now, service inflation is still on the higher side. As we saw on the first slide, the demand for services continues to be quite high, which is keeping wages high and consumption also well anchored. We do expect that going on, the base effect should play out, that from an incremental perspective, consumption should remain stable and probably this inflation that we are seeing between 2.5% should also get closer to 2% as overall demand slow down. Of course, for emerging market central banks, they have to face a very delicate balance. So while advanced economy central banks can continue on, their rate cuts, of course, barring Bank of Japan, which is on a rate hiking path. But for emerging market central banks, although their growth drivers are looking to slow down, they may have to wait for stabilization, especially on the currency front, before they decide to start reducing their interest rates. So the December FOMC meeting happened, which was quite washed out by market participants. The reason was this was the first FOMC meeting after the change in administration in the US. So market participants wanted to really assess that how the central bank is looking at its various economic projections, after the change in the government. And, as we can see, although it's not really a very material change, but nevertheless, if you look at the inflation growth dynamics, now the FOMC looks at growth slightly more constructively, and they also expect inflation to remain slightly on the higher side. So if we look at, for example, the growth estimates, the 2024 growth was revised from 2% to 2.5%, and 2025 was revised from 2% to 2.1%. On the longer run, of course, growth estimates remained unchanged. If you look at on the unemployment side, broadly, FOMC is just projecting unemployment number of 4.3% all across till 2027, so which is quite stable, and bond market took it quite negatively, that without a meaningful shift in unemployment, how will really labor cost come down, and how it will really lead inflation to come down. So the feedback loop that we have been talking about, that high services leading to higher wages and higher demand for labor, which is leading to lower unemployment rate. It was expected that probably at some point of time, it will decide to show in wage cost as well as unemployment, but that's still awaited for some time now. And that's the same thing is reflecting in your inflation estimates. So if you look at PCE inflation projection, that was revised from 2.3 to 2.4% for 2024, and the 2025 inflation estimate was revised from 2.1 to 2.5. The same trend can be observed in the core PCE inflation estimates as well. So what does it really mean for interest rate projections by the FOMC members? So as we can see in the September FOMC meeting, the interest rate, or the median interest rate, as at the end of 2025 was 3.375%, which was now revised to 3.875. And similarly for 2026, the 2.875% was revised to 3.375%. So what does it really mean? It means lower interest rate cuts, as can be seen by FOMC members as of now. So what it really means is that earlier the FOMC participants were looking at rate cuts of 100 basis in the next year, and after that another 50 basis. Probably now they are looking at a slightly higher for longer interest rates as things stand today. So if we can see, they're just now projecting 50 basis rate cut in 2025 and 1526, and just one more. So total they are projecting about 125 basis rate cut compared to 150 basis compared to earlier expectations. Again, even the Federal Reserve in the past has said that the dot plots are broadly estimates as on a certain date, and they should not really be read into it very seriously. But nevertheless, it does all the projections. If we take them into totality, it shows that the Federal Reserve is quite confident on growth, quite confident of lower unemployment. Hence, it is uncomfortable with inflation, and that's what's really playing out on their interest rate outlook. So overall, the FOMC meeting was taken a bit negatively from a fixed income perspective by market participants. And as a result of that, as we can see, there was a substantial sell-off in yields for the month of December. So the US 10-year yield, which was trading around 4.2% at the end of November, moved about 40 basis to end December at 4.57%. We can see similar movement across most of the economies. Of course, Brazil, we saw the highest impact because of a slightly higher inflation as well as fiscal deficit that Brazilian economy is facing. But broadly, most of the economies we saw a rise in bond yields. The only exception was China, which saw a decline in bond yields, which was due to the monetary and the fiscal stimulus provided by the central bank and the government respectively. And the expectation is that Chinese economy may continue to be on a slowdown path, and that's what really led to the rally in Chinese bond yields. But excluding China, across global fixed income yields, rose in December 24 because market participants are now expecting a much shallower rate cut cycle compared to what they were expecting in November of 2024. Coming to the financial conditions, so as we can see, so while bond yields have gone up, interestingly, financial conditions have remained quite stable. The reason is quite robust equities and very tight credit spreads. So as we know, financial conditions are not just a derivation from sovereign bond yields, but they also get derived from how equity valuations are looking and how credit spreads are really performing. And as now the bond market or overall financial market expects that global growth will continue to be quite strong in 2025 as well, that resulted into stronger performance of equity, especially in the US, and also as people expect lower rate cuts, investors are looking at high yield funds to basically chase accrual, and that's leading to tighter credit spreads as well. And that's what's really leading to financial conditions being quite stable despite the rise in bond yields. And if we look at the market implied policy rate forecast as we derive from the interest rate swap curve, 12 months ahead, market participants are pricing, in fact, less than 50 basis rate cut from the Federal Reserve. So any change in those expectations, if inflation continues to be on decline, will probably lead to further loosening of financial conditions index and also further rally in bond yields going ahead globally. So now we come to domestic trends, and as expected, we are now seeing decline in inflation, largely driven by smoothing out of weather-related disruptions, especially in food inflation. So as we can see, food inflation, which was about 9.7% in October, now fell to 8.4% in November. We expect it to continue to fall and get closer to RBI's estimate of 5.7% for Q3 FY25 and Q4 FY25. One of the major comforts that we derive is from stable core inflation. So given the slack in the local economy, core inflation continues to be on the lower side. And what that really means is that as weather normalizes, food production normalizes, overall inflation is likely to evolve in a declining trajectory. So we are more optimistic that by last quarter of this financial year, inflation will fall close to RBI's target of 4.5% as food prices continue their fall post the arrival of food crops, especially vegetables and fruits in the winter season. If we look at liquidity, one of the issues that has really been a major determinant of bond yields, especially on the short to medium end of the yield curve, is very tight liquidity due to heavy RBI FX intervention. and lower government spending. So broadly, as we can see, compared to November, we saw an average liquidity surplus of about 1.4 trillion. The average liquidity deficit for December was about 0.7 trillion. So apart from RBI intervention, there was also the GST and advance tax related outflow. So RBI continued to intervene in the interbank market by injecting temporary liquidity through variable rate repo auctions, apart from the CRR cut that they did in the December MPC policy. So as we can see on the orange line, yes, the call rates did go down. Uh, you know, Initially in the month of December, but post December, post in the advanced tax outflows, they continued to inch up, and they were close to about 7%. In going forward as well, this is a peak season for credit. This is also a time for aggressive deposit issuance by the banking system, and we also have tax outflows in March, which may not be spent by the government in the near term. So we do expect liquidity to remain slightly tight for this quarter as well, and that will probably keep short-end yields slightly on the higher side till RBI decides to aggressively intervene in the interbank market. So if we look at the credit deposit growth trends, so as we can see broadly, the huge gap which was there between the non-food credit and deposits is getting closer for the last 2 months because of RBI action and regulatory intervention, especially on the unsecured and personal loan space. So of course, November was a slightly busy season due to festival, etc. So there was a moderate pickup in credit growth, but broadly we do expect credit growth to largely align with deposit growth going ahead, and probably in the next 3 to 6 months, the aggressive deposit issuance that we have seen from banks should slow down, and that should lead to some normalization in money market as well as corporate bond yields. Coming to the fiscal trend, the fiscal position for India is looking quite healthy. So if we look at 8 months year-to-date fiscal deficit, that was about 53% of FY25 budgeted estimates compared to 51% in FY24. If you look at personal income tax collection, that continues to be quite high, but corporate tax receipts were weaker. This is something which has been highlighted by the corporates as well, because largely, FY24 was a period of lower commodity prices and hence higher corporate margins and corporate profitability, which resulted into better tax collections. Now that the reverse base effect is playing out, as the benefit of positive terms of trade for commodities has now largely played out, incremental margins and incremental profitability for corporates has been quite moderate, and that's what's largely reflecting into corporate tax collections. But from a fiscal perspective, what's really positive is that capital expenditure of the government is lagging behind even its previous year estimates. So while the government expenditure on capex has picked up in the last 3 months because of the model code of conduct which the government had to really adhere to from April till the elections. Broadly, we expect government to run lower capex this year, and probably government will surprise positively on the fiscal side compared to their budgeted estimate of 4.9%. So we expect fiscal deficit could come 0.2, 0.3% lower than their initial estimate, as overall revenue position continues to be quite healthy, whereas on the expenditure side, capital expenditure is still quite subdued due to inaction in the first 3 months of this fiscal year. So on the balance of payment perspective, of course, we had continue to see very strong service exports and strong remittance flows, as we can see in the FY25 Q1 and Q2 compared to Q1 and Q2 of last year. Our invisibles increased from 47.7 billion to 54.9 billion for Q1 FY25 and 64.1 billion from 53.3 billion in FY24, as well as portfolios flows, especially on the fixed income side, were quite strong at 19.9 billion overall because of the index inclusion. Going forward, we think that the BOP position may worsen in Q3 and Q4 because we are continuing to see FPI outflows both on equity and fixed income side. On even the net FDI on the equity side, we are seeing some outflows as foreign investors book profit and rotate into other economies from India. So probably for the whole consolidated FY25, we may see a slightly negative BOP that in a period of rising dollar puts pressure on rupee, and it leads to intervention from RBI, which in turn leads to tighter liquidity and slightly higher bond spreads on the short to medium end. From a long-term fundamental perspective, we still think that overall India's BOP position is quite healthy. India's FX reserves are also quite healthy. So while in the near term there will be some volatility which could lead to higher bond yields, we believe that investors should consider that rise, and probably as long as investors are looking to invest for a slightly longer term horizon, investors can take advantage of this kind of volatility which could arise because of FX pressures. But one thing is quite clear: as long as this trend in BOP continues, INR may continue to depreciate compared to the dollar. If we look at the trade deficit numbers, so they are also pointing to the same picture that one, you are having a position of negative BOP, which is also kind of buttressed by a higher and negative trade numbers, largely coming from gold imports. So if you see for November 24, the gold imports almost doubled from 7 billion in October 24, and that was largely the reason of a higher trade deficit. So if you also seen the softening global demand making its impact on the exports. So if you look at the non-oil exports, they also declined quite substantially from 34.6 billion in October to 28.4 billion. So broadly, the theme is of a worsening external balance for the last 3-4 years. One thing which has been quite constructive for India has been a very, very robust and strong external balance, which has kept the rupee volatility on the lower side. So we do expect rupee volatility to increase compared to the dollar. But if you look at India's position, whether you look at external account, inflation, or fiscal, compared to the rest of emerging market, it's quite strong, and hence relative to other emerging markets, rupee is continuing to outperform. So even if we take a longer term horizon, which is from September to December, rupee has outperformed most of the similar rated emerging markets. So which gives us slightly higher confidence or macro stability for India. So the SDL calendar, for FY25 Q4 was announced, which came about at about 4.7 trillion rupees. So while prima facie it may look to be on the higher side, but if you look at the trend in the last 3 years, typically states have borrowed anywhere between 60 to 90%. If you look at in their FY25 actual borrowing compared to their announcement, they have largely borrowed about 76%. So if you are assuming a similar run rate, the gross borrowing for states may not be very different than FY24, which is quite constructive for long-term government bond spreads. Broadly, if you look at Indian sovereign curve, we saw some uptick, like we saw discussed during the previous slides, that overall we saw a rise in global bond yields as investors reassessed and repriced their interest rate expectation from the Federal Reserve, and that led to uptick in bond yields. But if you look at Indian sovereign curve, the uptick was quite moderate compared to rest of the world. So broadly, as we can see, yields for most of the segments went up, other than if you look at AAA 5-year and 10-year, where yields came down because of strong demand from insurance companies and pension funds. So they have a certain statutory requirement that they have to invest in corporate bonds, and so which is quite price agnostic, and hence we continue to see very strong demand from these long only investors, which has led to broadly tightening of bond spreads compared to GSEC for the 5 and 10-year segment. So broadly on the outlook, so like we started, there is a lot of concerns and palpitations among the investors that what does really the change in administration in the US means for the rest of the world? What does Chinese stimulus means for the rest of the world? Where we are and how interest rate cycle is likely to play out. So while we do expect, and it's quite natural that there will be a lot of announcements possibly from the new administration, which will lead to some amount of volatility, which could even lead to some amount of disruption in financial markets in the near term. But what ultimately matters for markets over a medium to long term is the nature of the economic cycle. So if the economic cycle is constructive, of course, ceteris paribus rates are likely to be higher for longer. If the economic cycle is softening and growth is moderating, typically interest rates tend to be lower. And if we look at the economic cycle, whether globally or domestically, that has been on the softening side after very strong, growth of last 2 years now. Whether it's US or Eurozone, it's now facing growth challenges. The same is happening in India, where we saw very strong growth of 8% average from FY22 to FY24 because of the pent-up consumption demand because of public capex. But all those benefits are now kind of normalizing, and hence the growth cycle is moderating, and that should open up space by RBI for 50 to 75 basis of rate cuts in the current monetary policy cycle. So what does it really mean for investors? Given that we are still seeing a shallow rate cut cycle, we believe that moderate duration could outperform very extreme long end duration, and curve could steepen in this kind of scenario. So given that if you look at the shape of the curve today, your 1-year CDs are almost trading around 7.7% for AAA PSU banks or PFIs. Your 3 to 5-year bonds are trading somewhere between 7.40 to 7.5, and these are giving reasonable approval to investors. They are also giving an opportunity to investors to participate in capital gain once the rate cycle turns. So we continue to expect that given the growth challenges, at some point of time, RBI may have to move towards monetary easing, and that is when this segment should perform well. So broadly, investors who have more than 12 months investment horizon and have some appetite for mark-to-market volatility can consider allocation towards moderate duration strategies like short-term fund, corporate bond fund, etc. And investors who have a 6 to 12-month horizon can consider allocation to low duration or money market strategies. So thanks a lot, to all our investors for listening on this webinar. Now I will request Sonal to open up the floor for questions. Thank you.
Thank you, Anurag, for your presentation. It was quite insightful. The floor is now open for question and answers. Like I said, you can continue to post your questions while I'll start taking up the questions that we have already received. Anurag, my first question for today is, Last year, in your blog, you mentioned that year 2024 is the year of regime shifts. What is your view for calendar year 2025?
So we think for 2025 could be a year of chaos, and I am differentiating is with uncertainty. There is always uncertainty in markets. So that's not something which is true for 2025, which wasn't really true for 24 or 2021. Uncertainty is always there. If there was no uncertainty, I mean, everyone will be earning the risk-free rate. What we expect in 2025 is probably disruption. So, like we discussed during our presentation, that when there's a change in the administration in the US, especially which has come on the plank of anti-immigration, higher tariffs, tax cuts and business deregulation, there will be a lot of announcements. But what we really have to realize, and which we have to cut through the noise, is we have to wait for impacts to really play out, because for every action there is an equal opposite, typically reaction from other parts of the world. So we don't know how the net impact on growth or inflation for any measure is likely to be. And secondly, we are already in midst of a business cycle which is slowing down. So it's very unlikely that any measure could really change the direction of the business cycle in a meaningful manner. So while one can, of course, governments by their actions can, change the magnitude, but it's difficult to change the direction. And given that we are in the midst of a global moderation, so probably we do expect from a long-term perspective, global growth as well as domestic growth to slow down. But yes, the journey towards that could be slightly not just uncertain, which is always there, but slightly chaotic as well.
Sure. The next question is, the economy grew at 8.2% in financial year 2024, and the government's advance estimates for current fiscal year is below Finance Ministry's forecast of 6.5% and 6.6% projections by RBI. Till how long do you expect this weakness in growth to continue? What are you expecting? When are you expecting a recovery in the GDP figures?
So we are expecting further moderation in GDP figures. We think the actual GDP could even be lower than RBI's projections for this year and next year. The reason being that if you really look at the drivers of growth, the major driver of growth, especially for India, is consumption, which is about 55 to 60% of growth, followed by public capex, export demand, etc. So, and given that consumption is 55 to 60%, that also depends a lot on disposable income and not just on employment or wage growth. So there's a probably a misconception that employment generation is low in India or wage growth is low in India. That's actually quite above trend as far as these two aspects are concerned. But what's really happened in the last 3-4 years is, as the government had to consolidate fiscally, because of course in COVID, every government in the world had to spend to support weaker sections, which we did as well. But the consolidation has largely been on the back of individual taxes, which has really led to decline in disposable income for individuals. And typically, whenever there is this kind of a trend, it takes time for consumption to really pick up, barring any big bang measures. Of course, government has the capacity to really go for big bang tax cuts and really revive growth from the personal consumption perspective. But as things stand today, if the current trend continues towards fiscal consolidations, especially on the back of individual consumers, we do expect consumption to remain slow. On top of it, that what we are seeing is that that global demand is moderating. So potential export growth from India as well is slowing down. We saw that in the trade numbers, where we saw the decline in non-oil exports in November compared to October. So while the magnitude may not be the same, but nevertheless, the pickup in global exports that we could have predicted 2 years back, that pickup may not be there. And hence, both from an export perspective or domestic consumption, things on the growth part, I think look quite moderate. And that's actually quite constructive from a fixed income perspective, because that means that at some point of time, RBI may have to undertake rate cuts to really stimulate the economy.
Sure, Anurag. The next question is, what are the key drivers of strong recovery in PSU asset cycle, and how does this align with government spending trends? And with the private capex cycle remaining sluggish, how critical is government capital spending in driving economic growth?
So as we have seen in the last 3 years, government spending has been the second biggest driver of growth after private consumption. And of course, given that India requires infrastructure in key areas such as roads, power, railways, etc., where typically government is the first mover, government, capital expenditure will be critical for overall lifting of our potential growth. Having said that, I think government has been doing its capex quite robustly. Only in this year, because of election-related code of conduct, they could not undertake the capex in the first 3 months. But broadly, in the next financial year, we do expect government to continue its overall level of capex as a percentage of GDP. But if you look at the capex as a percentage of GDP, that's somewhere between 3.3 to 3.5. So given that government is in a consolidation path, and there is a capacity to government capex in a short span of time, we think that probably as a percentage of GDP, the capex will largely be maintained. And that's why we think that growth next year also may be in the similar range as FY25.
Sure. The banking system is facing liquidity tightness despite CRR being cut in 2 equal tranches of 25 bips each last month. How do you see system liquidity in the near term?
So system liquidity, apart from leakage in currency domestically, is also a function of FX outflows and how much really function of central bank intervention at the time of this outflow. Given that RBI has been intervening quite aggressively in the market to stabilize INR, that's really sucking out liquidity. And also, given that RBI is intervening on the FX forwards market, what's really happened is that the forwards rate have opened up quite significantly compared to interbank rate, which has led to even the money market rates going up in the near term. So despite the CRR cut and despite policy rate being where it is, your money market rates have become more volatile, and they have started to go up because of the intervention in the FX market. If we look at the lay of the land today, we do expect FPI flows to be volatile for the next couple of months. It's also a busy season for credit. So unless and until there is a major measure from RBI, which infuses significant amount of liquidity in the system, we do expect one, liquidity to be slightly tighter. Secondly, we expect that irrespective of the price of overnight rate, so overnight rate could remain well below in the range of 660 to 680. Your money market rates could continue to be on the higher side in the near term. which present, investors who are looking to invest from a 6 to 12 months perspective, a good entry point when they are looking at money market funds or a low duration or ultra short, kind of strategies, because it gives them a good starting level of yields in this scenario, which they can capitalize, especially if they're looking to remain invested for 6 to 12 months in the future.
Sure. Foreign investors selling and rising crude oil prices continue to weigh on INR. What are the expectations now? Do you see any intervention being made by RBI to stabilize rupee?
So RBI has been intervening actively in both the spot and the forward market to stabilize rupee. So as you can see, although the volatility for INR has gone up, but if you look at in the last 3 months, INR has been a stronger performer than many of our emerging market peers like Indonesia, Malaysia, Korea, Taiwan, etc. So that's RBI's actions on that front have really helped. But overall, like I said, in response to one of the earlier questions, you can reduce the magnitude, but you can't reduce the direction. So if overall, there is a global theme of dollar strengthening, stronger dollar, US exceptionalism, money is moving back to the US, or probably money is rotating into China because there is expectations of stimulus there. So in the near term, it may have a knock-on impact on other emerging market currencies, and rupees no exception. Although relatively we have outperformed most of our peers.
Next question is, the RBI appointed Mr. Sanjay Malhotra as the new governor. In order to balance between inflation and growth, RBI kept interest rates unchanged since Feb of last year, or rather last to last year, I would say. How do you think the new governor will look at this balance? Are you expecting any changes in RBI's approach?
So we think that RBI is an institution, and as an institution, it has the mandate of inflation targeting, as stated in the RBI Act. And we think that irrespective of the change in the MPC members, we do expect RBI to focus on inflation targeting, keeping in mind the policy objective of growth as well. But if you see, since inflation targeting was announced in 2016, there have been change in MPC members, whether internal or external. But broadly, the focus of MPC has been towards macro stability. So we do not know whether there is any change in reason to think that the new MPC may think differently. We think that the new MPC will continue to focus towards macro stability.
Surely. Retail credit growth has declined to 16.3% due to drop in personal and vehicle loans, and also rise in credit card outstanding. What are your thoughts on the credit growth in the near to medium term?
So we think over a long term, credit growth is a function of nominal GDP. So if nominal GDP is declining, credit growth also typically tends to decline. And that's a healthy correction. Because if your nominal GDP is declining, but credit growth is not declining, that means that credit is going to probably some unproductive sectors of the economy, and that may result in weaker bank balance sheets going ahead. So in fact, that the credit is slowing down shows that overall banking system is also looking at overall economic growth, overall demand for credit, and also fine-tuning their growth ambitions accordingly. So we think that the declining credit growth is actually, at least from a fixed income perspective, quite healthy for macro stability.
Anurag, in the interest of time, I will take two more questions. As we come near the end of fiscal year, do you anticipate some sort of increased capex expenditure because that may at least support corporate earnings in the second half, if at all. Do you see that as a possibility?
So I don't know about corporate earnings, but I think given that there is a substantial uh, lag in capex in the first 3 months of this fiscal year because of election-related code of conduct, we think that the government is already cognizant that it has to spend aggressively in order to boost public capacity and increase employment. And that's where I think the focus of the government has been for the last 3 months. If you look at in terms of tax devolution to states as well, it has increased the run rate of tax devolution to states to enable the states to spend faster and more effectively. So we believe that on the other areas of capex also government may continue to engage more actively, and they would prefer to spend as much as possible in line with their budgetary estimates. Uh, so that will happen, but like we discussed, the overall consumption is slowing down, and hence it's unlikely that the overall nominal growth will pick up materially.
Sure. The last question for today is the next event would be the union budget next month beginning. What do you think are going to be the key focus areas of government this time around? What can the budget do to try and fillip growth? I mean, could we hear something on capex? Any specific steps to boost consumption?
So we have multiple events. We have the new US administration taking charge on 20th January. So from 20th January till 1st of Feb also there are 10 days, and there could be some announcements on tax, on immigration, etc., which will keep markets engaged. On the 1st of Feb, there's union budget. And then on first week of February, there's also the MPC policy of RBI. So yes, for the next 1 month is quite, I would say, important to look out for from a point of view of financial markets. Having said that, I think yes, there are talks that the government is having discussions with various stakeholders to boost growth, and there will probably be measures to support growth from a capital expenditure or from some tax benefits for middle class as well. But again, having said that, these measures overall may change or may modify the direction in the near term. Whether it's the budget or the interest rates. I mean, just to give a perspective, US has had the highest tightening of interest rates it had in last 40 years. So when interest rates were hiked from 0 to 5.5 in the US, market participants were expecting a hard landing in the US because of these exceptionally high interest rates. But guess what? After 2 years, US still continues to do quite well, despite all the rise in interest rates, right? So, so on the corollary, we don't really, like I said, so while government measures or RBI measures may incrementally provide some direction to the economy, but ultimately it's the economic cycle which matters for the market or for overall business sectors as well. And I think that's where we have to focus on. There will always be events, there will always be budgets and MPC policy or other events, but broadly I think it doesn't change the long-term narrative.
Thank you, Anurag, for taking up all the questions. On behalf of UTI Mutual Fund, I convey our sincere thanks to all our viewers for actively participating in today's webinar and asking questions. Please do share your feedback on the link provided. We look forward to connecting with you in our next webinar. Post closing remarks to Anurag, we can conclude today's webinar. Thank you. Good day.
Thanks to all our listeners who are joined in on the webinar. Hope you found the session useful. Please feel free to send us your feedback, and we do hope to actively engage with you in the upcoming webinars as well. Thanks a lot. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.